If I look at a spreadsheet looking at financial projections, I always say more fiction is written in Excel than is written in Word, so I don't believe those numbers at all. But I use that as a proxy.
It is about hyperscale. It's also about whether you as a founder want to start that journey.
One of the key factors that really distinguishes great entrepreneurs from okay entrepreneurs is how far great entrepreneurs can go with no capital.
With venture backable, there's a clock to it. And when there's a clock to it, means there needs to be an outcome at the end to return capital to those early investors.
It's going to be high risk, high reward, high octane.
Don't put in how many pitching competitions you've won, it doesn't really matter.
You could be doing anything in the world. Why are you waking up every morning and going to bed every night focusing on this problem?
Our focus in this chat is all about what makes a startup investment ready. How do we know? What are we looking for? What are the signs? So I'd like to start with looking at what's the single biggest difference between a business that's profitable and sustainable versus one that's truly needing venture funds?
I mean, I think that one of the hallmarks of a venture backable company is one that has the potential and the desire to hyperscale. And that's part of our job as investors, is to feed them capital, so put that fuel on their fire that helps them grow exponentially. There are lots of amazing businesses out there that you mentioned that are profitable from day one or early on, and those are great businesses, but that's not what venture capital is. So venture backable companies have a very unique attribute. Usually they're able to scale exponentially using technology, and capital is their food. So we put capital in and we watch those companies grow.
I think the other aspect to add to that is when we say venture backable, we imply that the option is at our discretion to invest in these companies. It's also whether or not the founder wants to go on the VC journey as well, because there are fantastic SME companies that maybe the founder may be very happy to continue on the road that they're currently on, which is very different to what, starting the VC clock per se would actually mean for the company. And it is about hyperscale. So I think it's also about whether you as a founder want to start that journey on VC. It's going to be high risk, high reward, high octane, compared to saying a VC, in an SME company, which is still requires incredibly hard work, and could be a very long journey, but it's a very different profile of growth than a VC backed company.
I think there's an element around the capital intensity of the business as well. So there's a general acknowledgement that there's a heavy R&D phase where it's capital intensive. You need to put the effort in, you need to build the product, and then you see the realization with the market. So where a lot of more traditional SMEs, you're trying to find a more linear growth cycle where you're finding a balance between profitability and keeping the company alive versus actually being able to take external capital, really inject that in, build and go through essentially that J curve and then come out on the back of it, hopefully with a high growth trajectory.
I would also say being a VC backable business doesn't necessarily mean that you're not sustainable either.
I think there's also a piece to the puzzle which founders need to acknowledge is how do we get our money back as an investor? And so generally when you look at an SME, you can hold on to that forever. You can have great profitable businesses. You might go through the private equity pathway, but with venture backable, there's a clock to it. And when there's a clock to it, means there needs to be an outcome at the end to return capital to those early investors or even growth investors.
So as investors then prospecting at the early stages, what are those signals or what are you looking for that are going to predict that founder or team can execute at scale?
Well, I think we're never able to predict. That's why our work is high risk but high reward. But we are looking, we have to work backwards from what do we need to believe to be true for this company to return the fund. And so each investment that we're making, we have to believe that it has the potential to be a Canva or an Atlassian. We know that it won't, and statistically, very few of those companies will become successful like that, but we have to believe and have conviction that each one has the potential. And so, there are lots of things that I think each of us look for, and it's stage dependent or thesis dependent, but certainly we're looking for a clear articulation of a problem in a very large and growing market, and the founder has some unfair advantage to be able to be the one that's going to pull this off.
I think, one of the other things that I'd mention as well is one of the biggest and best indicators of a company's ability to be successful in the long term is to be able to attract world-class talent, not just as employees or investors, but also just advisors. And the truly terrific founders at whatever stage they're at are able to rally a group of people around them and charge down towards the vision that they've got.
And when you say vision, can I clarify there, is that showing some kind of, visionary characteristics in their personality? Is it a leadership capability? What's the actual founder X factor that shows that they could grow a team?
There can be charismatic founders, but I don't think that's a precursor or a prerequisite to success. I think it's more having a view of how you think the world is going to look in 5 to 10 years' time, and understanding it's not going to be a clear or direct path, but that you have got a way to shape whatever vessel you are going to sail across the 7 seas to get there and come out the back end.
I've actually been doing a bit of research for our team internally recently around the latest studies on founder characteristics, which are most correlated with success. And it's always hard to know whether these things can be relied upon. Of course they can't, and there are always outliers. But I thought it was interesting that the 2 characteristics that were most positively correlated with success were adventurousness and extroversion. And the 2 that were most negatively correlated with success were modesty and anxiety. So I thought that was really interesting. And there was another statistic that, again, there are always outliers. Companies that have 3 or more founders are twice as likely to succeed as companies with a solo founder.
It's interesting to hear about those attributes and what Rohan was saying about the ability to attract talent. I would say that great founders need to be a magnet, and the things they need to magnetize or pull in their force field is amazing talent, so capabilities around themselves, customers, the ability to sell, and those early sales are going to be founder-led, and capital, the ability to get the resources on deck. So I can see those 2 comments really coming true in the founders that we have backed that are exceptional, have that ability. And whatever those personality traits are, they have that ability to be that magnet.
You talked about size of market. This is a big growth opportunity. How do you assess whether a market is going to be big enough if it doesn't exist yet?
Don't worry about it. It'll work itself out. I know you might think I'm being flippant, or I'm see you looking at me for more, but I think if you are a founder and you're building a company in a new market, oftentimes the niches grow over time, and if they're growing at a decent clip in 10 years' time, it'll be a decent size.
Disagree a little bit in that I believe, or I should say that at Flying Fox, we are looking to invest where the market size has already been proven because there's been a pain point that hasn't been sufficiently solved yet. So while there might not be a market for that product because that product is new and customers are not yet aware of it, the pain point or the problem to be solved is well established. And then we look for what are the tailwinds that are happening, what trends are taking place, what behavioral shifts are happening, what regulatory changes are coming about. That means that I always say, what is impossible today but will be inevitable tomorrow? And then you believe that the market will follow. So I agree, sometimes you don't know what the size of that market is, but there are these leading indicators of there is a real pain point. It is felt by many people. It's extreme enough that they're willing to pay money and the current solutions are insufficient. And then there are all of these things behind it that will make it possible when yesterday it was impossible.
I completely agree. I mean, if there are founders watching, you can do that. You don't need to worry about the market size because that'll take care of itself.
So at what point does a startup then, they might have a big bold vision and there's a big opportunity, but at what point, how are you determining whether it's too early, what more do you need to see, or whether they are investment ready?
I was thinking about this earlier. I think one of the key factors that really distinguishes great entrepreneurs from okay entrepreneurs is how far great entrepreneurs can go with no capital. And oftentimes when you're speaking to an early stage founder who wants to raise capital, they're not quite aware of just how much more progress they could make without needing to raise money, which is in their better interests as well as ours, in order to actually prove the thesis and then go and take the next steps. I think oftentimes it's overlooked. So when a founder's coming to us and there are obvious steps to be taken, that they could take the concept further and they haven't taken them, that's a bit of a red flag.
At Flying Fox, we never think it's too early to build relationships. And so that is really important to us, is that we want to meet founders when it's still eye-wateringly early and build that relationship. And then it's our job to stay close to her or him and say, hey, listen, when X, Y, and Z happen, so when we're starting to see these bright spots of customer attraction or customer love, or the product is actually doing what it's saying, we want to know about it and we want to be your first check. And then at Flying Fox, we actually have a little mechanism where before we invest other people's money, we invest our own. So off balance sheet, and not a lot of people know this, but Kylie and I make decisions where we place small bets And that's a way to build those relationships early, get asymmetric information, and so then we know when they're investment ready, and then that's when we bring other people's money alongside ours. So that's both a way that we start early, and then a way where actually we signal and put our money where our mouth is, so that we know when it's ready to get that first big check.
Is that an insight you get through understanding how they behave when they have someone else's dollars in the bank? Or is that just a piece to have a seat at the table so you can have the insight, so you have first information?
It's more the latter, but that's an interesting question because the
Yeah.
former is interesting. Usually it's not a material amount of money, but it's enough for them to invest in the product that they needed, or maybe make a hire that they needed just to get that early traction. And it's to have that seat at the table and to show them that we are high conviction on them as founders and that we're in their corner.
There is no amount of DD, I think, that you can do that is as good as putting in a check early and watching them for 6 to 12 months and then doubling down.
I mean, the reality is most people haven't raised investment before when you're in startup. And so taking someone else's check changes. And I remember running an accelerator where when you put that first 30, 50K check in, the founders completely changed their attributes and how they behave. And they realized that, oh, this is not just ours, but also we need to take more money on the future. And so there's a bit of a journey shift and a behavioural shift we see once you take your first check.
Accountability, having to answer to someone, having to actually front up and justify decision making for the first time.
And hopefully they see what's possible, right? They get excited about, with more capital, what can I do? So some of the questions that we ask founders is, with this money, what would you do? And then one of the questions I was taught to ask at Amazon is, if I gave you 10 times the amount of money, what would you do? If I gave you 100 times, and it's just an exercise to think about how big can you make this? Make sure that they're thinking, really ambitiously. And of course, I can't materialize 10 or 100x the capital, but it's an interesting exercise to see how ambitious they are and how big they can imagine this to be.
So on the 10x, 100x, 1000x, we've seen AI. We're in that hype now. We're in that bubble. And so what we know is people can do a lot more with a little. And how is this influencing the way you think about how much capital a company needs, given they can 10x themselves or 1000x themselves with some of the new AI capabilities?
Yeah, that's a very tough question, because I think one of the things that we've seen a lot of recently, and I'm interested to get your views as well, is we're seeing a lot of very interesting here and now companies that do not seem to have defensible barriers to entry or some sort of moat over the long term. And traction is not necessarily the proxy that it used to be for defensibility. And so whereas previously you'd have a founder come to you and show steady growth, and that would be a really good way to assess the need in the market, you're seeing some of these companies blow revenue up and then just as quickly blow it down again. And so that can be quite a challenge. But I think that's where, again, in a lot of the interviews we've done recently with founders of AI companies, it has been around what is their vision for the 5 to 10 years, what kind of company do they want to build, what is their view of how the industry is going to evolve, and how can they shape their company to take advantage of that. And I think that's become increasingly important.
I always say that the investment process is a series of lily pads, and you're trying to jump from pad to pad, and the questions you need to ask yourself at each of those lily pads are different. And so, when you get a deck, I have 30 seconds or 2 minutes to decide if I want to have a coffee meeting or 30-minute Zoom with this founder. So I need to ask myself, what needs to be true about this deck that makes me want to give up 30 minutes of my time? And usually that's around, I'm like really intrigued, or there's something compelling, and it's usually I understand this customer problem and it seems like it's happening in a really big market. Then with the coffee chat, there's another series of questions that I'm asking, which is how clearly can this founder articulate that problem, and why is she or he uniquely qualified to knock it out of the park, and how big could this be? And then that makes me want to go into DD. And then in DD, that's when I'm actually looking at the product, I'm looking at their sales and marketing chops, I'm looking more deeply at the problem, I'm talking to customers, speaking to experts, and that is making me decide whether or not I want to make the investment. And then of course we go into terms and negotiating the finer points. But I think it's important for us to let founders know that when each stage of that process, I'm not deciding, am I investing? I'm saying what needs to be true to advance the process.
That's right.
And so there's a different series of questions I'm asking, different things that need to be true, and a different level of diligence that I'm putting into each step of the process.
So how much should founders prepare the diligence for you? if they are making an approach to a particular firm, how much DD should they literally do to ensure
I
that they're
can give you a
providing
starting point. The first thing that would be great is if you just read the investor's website. Because honestly, I mean, I think a lot of founders approach VC firms and think that every VC firm can invest in every type of company. And they don't realize it's actually a Venn diagram where the founder needs the check and the terms to work for them, and so does the investor. And no matter how great your fintech is, Tim is not going to invest in it because it's not part of their mandate, because they haven't raised their money from their investors to be able to invest in that type of company. And it might be around the size of the check as well. Oftentimes we get people coming to us saying they want to raise a $5 million round. And you're like, well, that's fantastic, but we're not going to be, a large enough check to participate in that round. So you're wasting your time by coming to us. You're better off going to other groups. So the first step is just read the website, and then it's common sense.
I think that there's a Goldilocks, especially for me as an early stage investor. So I think that good founders are structured thinkers, and structured thinkers have materials that they want to share with me. And so I always say to founders, don't create materials just for me, for due diligence, because that is
Waste of your time.
a waste of time. But good founders have put their thinking or their strategy, they put ink on paper, and they want to share that with me to help communicate their vision. So I love when I see that. If I look at a spreadsheet looking at financial projections, I always say more fiction is written in Excel than is written in Word. So I don't believe those numbers at all. But I use that as a proxy. And the proxy I'm looking at is, how does this founder think about the growth trajectory of this company? And what kind of ambition do they have? And is it realistic? Is it ambitious enough? Is it too incremental? So I use it as a proxy for thinking. The same thing about product. When I am investing early, that's not the product that's going to make me lots of money and change the world, but it's a proxy for their product sensibility. How do they understand the problem, and how are they thinking about solutions in different ways? So what they have in their data room for me is it's almost clues. So it's not answers, it's clues, and then it's my job to hold up the magnifying glass and to decipher what these clues mean.
To be clear, the data room includes a pitch deck,
Yes.
financials,
Yes.
Cap
Sometimes.
table?
Yeah.
cap table. What else would you be looking for in that set of documents, if you like, for a founder?
I think there's a misnomer that investors look at things in a data room for the sake of looking at things in a data room, and that they're not actually requirements to run a company. And so I do think that these are things that a founder should have in place if they are structured thinkers. And it's the key information. You would have employment agreements if you have employees. You'd have a shareholders agreement. You'd have your financial model. You might have a profit and loss and a balance sheet and those sorts of things in there. But it's the sort of information that the founders should be using to actually run their business too.
Yeah, I think, look, ultimately, if you're a founder and you're raising capital, ultimately you want to reduce that friction into raising capital. And anything that creates difficulty or friction or extra clicks for that investor to do, and that includes reconstructing a financial model, especially in the later stages, just makes it harder. And I think founders are just so incredibly talented at reducing friction on the customer side and on the product side. Anything that you can do to make it easier for an investor and make it a faster decision is better.
So what's one question then, you've got that process, you've got your documents, what's one question that you would ask or have asked of a founder that reveals a lot? When you're assessing, you were talking before about you're assessing for, has this founder, are they thinking big enough? Are they able to be the magnet? What's a question you could ask them that's going to be really revealing from that point of view?
The first question I ask, so I always introduce myself first, and I take 15 seconds to do that. And then I say, I want to get to know you a little bit better. And this is the question I always ask. You could be doing anything in the world. Why are you waking up every morning and going to bed every night focusing on this problem? And that's where I want to appreciate their understanding of the problem and their obsession, because that is what's going to help them go the distance. It's not going to be their financial model, or they're really good at coding, or it's going to be that day in, day out, they care enough about this problem that they are going to dedicate the next 10 to 12 years of their life on it. So I ask them that question, and I usually find out something personal about them as well, and I understand their why.
So what about if there's an opportunity that comes your way that doesn't fit your pattern or your thesis, but it's a white space opportunity and you've got high conviction on that?
Well, actually, I'll give you 3 quick examples of actual companies that are outside of our stated thesis, and I'll tell you why we made those investments. So the first one is Heaps Normal. So we're very clearly, we invest in technology, whether that's software or hardware, not in CPG or FMCG companies. And here we are investing in a beer company, non-alcoholic beer. So why did we do that? Because we knew the founders and they were incredible. And there's all this story that we told ourselves at the time, because they were kind of selling DTC, that it was more subscription. It was kind of like software, but really, We thought the category was going to go gangbusters, and we were right. And we thought that this team were really knowledgeable and super passionate, and we just wanted to be on their team. So we broke the rules because we met great founders. And we have over $1 million in that company, and we're so excited about what they've done.
We would make an exception for a founder. And I think the founder also probably blends into your description as well, where they can identify a market shifting or potentially technology, technological change, but it would always be centralized on a founder. And one example of that recently is probably Ed Semble. This is a company that we've put almost $1.5 million into over the last year or so. And that is a learning platform for kids 0 to 5 years old. So it's EdTech business, but they started off by buying kids' books off the shelf on Amazon, repackaging them into a book subscription package, but they're now developing their own books using best practice from research articles to improve learning outcomes and help kids with developing emotional maturity and all these sorts of things. And that's a company that we've backed because of the founders who've got experience raising dozens of millions of dollars in venture capital and have got deep domain expertise in EdTech.
And we joined you in that investment,
Yeah, I'm pretty sure.
breaking our thesis as well.
Yeah,
So there you
that's
go.
one of our co-investments.
Double deviance.
There's some more money coming in there if you want it.
Great.
Yeah.
So what about really early stage, pre-seed or seed? How hands-on would you get with founders at that stage when they need a lot of hands on deck?
I think it depends a bit on what their needs are. So the way that we talk about it with our founders is they should have far more domain expertise into their market than we will ever have. But we have a vantage point of 81 portfolio companies going from pre-seed to seed to hopefully Series A and beyond. And hopefully that's something they only ever have to do once. And so we can help remove some of the friction through that process if they're willing to work with us. And so that can be things like just getting the financial management system in place to be able to report on your metrics and understand what your churn and your adoption metrics are and those sorts of things. It could be understanding your go-to-market and what the key sales and marketing channels should be and packaging that up in a way which can be systemized so it can be taken away from the founder and delegated to early team members who you're probably hiring with the capital that we are giving to you. So it can range from a bunch of different things, but generally speaking, it's around those fundamentals, starting to put some structure into the chaos that can be an early stage company.
As one of the portfolio companies of ours, we had a very strong-minded founder, and they were very adamant that this is the way to do things, but they never managed a team before. And so the chairperson of the board actually had breakfast with the founder every fortnight above the monthly or 6 weekly board meetings. And that breakfast was very much around the direct relationship. How do we make you a better executive? How do we make you a better CEO? How do you manage a team? How do you grow a team? And it was very personable over the actual governance of running it as the chairman of the board.
Do you always take a board seat?
Our preference is.
Absolutely not.
For our equity funds, yes.
We have 2 or 3 board seats in a portfolio of 81 companies.
Right now, it sounds a little bit like asking for information is a bit of a stick. Like, you need to give us that information. And if you can make it a little bit more of a carrot, i.e. show them that when they share, you are helpful, that tends to improve the quality and the quantity of the information that we get. So I try my best, and it doesn't happen for all of our portfolio companies, and certainly doesn't happen every month. But I do try and read these updates, and I try and reply back. So whether they have an ask that I can help them with, or I just give them a high five because that was a really great win, or I can see something is tough and I just say like, hey, you've gas in the tank, like looks like you're really doing it tough. It's showing that this information doesn't go into the ether and that we're responding and here to help. And so anytime I can look at it and I say, hey, I'm noticing this, let's jump on a call and talk this through. It's positive reinforcement that this information is going to help them. So it's not just a reporting exercise. This is a help us help you situation.
I love reading, for those who have a backlog of monthly updates, when going through the due diligence process, I love reading it because it feels like you're on the journey with the company, even though you might have only known them for a few weeks. And so I think there's a piece around not just documenting and having the accountability, but also for those who are new on the journey with you to actually say, hey, here's a folder and follow it through with us.
I don't think many founders actually clock that those emails are actually marketing emails. Because if you just need to have a few different paragraphs, but if you can name drop all the amazing people that you're meeting with and the traction that you're getting, and all of a sudden you're creating some FOMO from investors like, oh, all of a sudden they've had a meeting with Andreessen Horowitz or somebody else or something like that. It's just this opportunity to create, some support for you. Don't do it in one of those braggy ways, which can be done, and I know you're laughing because you've seen these too, but it can be done in a professional and clinical way, which actually can really position the company strongly, in my view.
So everyone says build relationships before you need them, put the check in early, start developing that rapport. But networking is a bit of a dirty word. So how do founders do that without being a bit networky and cringy and transactional? How do they develop those relationships?
I got a starting point here, because I think one of the things that the founders don't realise is when they're asking for half an hour of your time, they're asking for your scarcest resource. So I think part of it, to set yourself off on the right foot, is to say, look, I know you're a busy person, or not even saying that, to be honest, but not expecting the person that you're trying to engage with to spend time on you in order to build a relationship. Hey, I've started a company, this is what we're doing, here's our pitch deck, I'd like to put you on our monthly emails, is that okay? Great, please tick, win-win-win, everyone's happy.
Yeah.
I just, maybe to offer a bit of a contrarian view on how the investor update should look, being at the later stage and working with companies that are potentially 3 to 5 years away from exit, you actually do need to be really careful around how you craft investor updates at those later stages. Often at the later stage, you kind of drop off and stop doing them anymore. But you have to be really, really careful when you start moving towards larger raises and exits, not to be viewed as being constantly raising. You might secretly be constantly raising, but you don't want the market to know that, because no one wants to be the house on realestate.com that hasn't been bought and no one knows why. So it's really important to control your messaging of when you're in market and when you're not in market. And that doesn't mean that if you go out and try and raise and you have very wide distribution of materials, if that's unsuccessful, there's nowhere to go. It just means that you take the data points that you learn, you go away, you reevaluate either internally, or you wait until the data points are different externally, and then go back out to market again. So I would just be really mindful around, as you move towards those later stages, I would probably say Series A+, be a little bit more mindful around what you share in those investor updates. And it could be mentioning anecdotal forms of traction. We met with X customer over the past year, or the founder has now moved to the US. All those things are really interesting, but oftentimes your investor's going to be very mindful around the kinds of metrics you're sharing more broadly to the market.
So that's later stage, and then thinking about really early stage founders, hustle is part of it. How big can this get? How big is your optimism? Sell me your vision versus the reality of where they're at. How do you balance that? How do you assess for that?
You want someone who has this big, ambitious vision for where she or he's going to take the company, but is really clear on what the step functions are to get there. And we can work backwards. So I'll give you an example from my portfolio company right now. They're doing a follow-on round, and actually the company's doing great. I'm totally, I'm in there. But I saw in their pitch deck, they said they're at just under, they're at like 750K ARR, super early. And they're like, and with this investment of $2 million, we're going to get to 8 million ARR. And I was like, okay, like which companies have done that? Like which companies in 12 months goes from 800 to 8 million? Like that's pretty impressive and very hyperbolic. And like that's not going in my deal memo. And so what I want is there's a fine balance between I understand where you want me to get because this is a VC backable company. I understand what exponential growth looks like, but I'm really clear on what's realistic with the amount of capital I'm putting in, the amount of time that I'm taking, what's in my pipeline, and what is actually feasible. And so that's where I want to make sure that their feet are on the ground, but their eyes are looking to the sky, and I need to see more.
So if we think about then that early stage, and founders are often working with this, massaged pitch deck, the holy grail. What's one big mistake that you see on pitch decks, and how could you educate founders around what they should be focusing on instead?
I think tell your story. I think founders, really, particularly those that are doing their second and third or, a Series A+ raise, is you have had a lot of achievements. You have built a great company, and you should lean on what you have built and tell that story and where you're going next. I think we get stuck in, we build a pitch deck, we have a standard pitch deck format, the problem solution numbers, and that is fine at the early stages, but I think more and more we're seeing this traction slide move to slide 2, and it's very much, this is what we've achieved, this is where we're at, this is how we create FOMO, this is why you should be on the journey with us now. So I've really enjoyed seeing this really story about what have they built versus what are they trying to build, because as an early stage investor we see all pre-seed investment rounds where you're literally funding to build. It's like, no, you're past that stage, right? And you don't want to keep looking like you're a super early stage company even though you have a whole bunch of product and traction behind you.
And I think I'll add to that, Tim. I like when they say, this is the traction that we've had, and they get to brag about that, and then ... and we're just getting started.
Yep.
And that gives you an idea of how much headroom there is still to go. And that's what I want to see. I want to see that constant velocity, that growth trajectory, and the belief that it's still day one.
And you want to see the headroom both in market, which is achievable right in front of them, but also where they want to moonshot towards, and then also a headroom in product growth as well.
Yeah.
Because the product you see today is not the product that's going to be ultimately getting them to achieve 10 mil, 100 mil ARR.
I think we have to give the founders some really practical guidance right now, because a lot of this stuff is absolutely right. But I think a couple of red flags and things to avoid is, one, don't put in how many pitching competitions you've won unless it's the EY Entrepreneur of the Year award. It doesn't really matter. The second thing I would say is a lot of founders spend most of their pitch deck focusing on either the problem or potentially the solution, and that is literally 1/4 probably of what we want to know. What is the market size? What is the team? What is the traction? What is the competition? What are you asking for? Those are the key things that you want to see. To use your lily pad reference from earlier around, is this the deck that I'm going to spend 30 seconds to 2 minutes reading? Is there enough information in there for me to make an assessment on whether I get to a 15-minute or a 30-minute phone call?
So it's kind of why this, why now?
Yeah,
Just straight.
it's a business is more than the problem and the solution. A business is, got to look at those fundamentals, like what is the market size, what is the opportunity, what are you asking for?
So 2 red flags for me. Often when it's a small team, you build it out with your advisors. Make sure you have spoken to every advisor and got their consent. Trust me, I will either text them, call them, email them, and go, hey, are you actually working with them? Or what are your thoughts? So that's one piece, is make sure everyone that's on your pitch deck you've got consent for, and then and can endorse you, that they know that you're sending this out to.
Big red flag.
And the logos.
Getting a bad reference
That's
to someone
right.
on your pitch deck.
Then the second piece is unit economics. I think so many times founders put out this great narrative and a great story about their pitch and their company and the journey, but then you look at it and underneath the core unit economics, either they don't know it or they don't have it at all. And that is a massive red flag to us, because there are so many, particularly in hardware companies, where they don't know what their revenue model is, or whether they're leasing, hardware as a service, purchase, etc. But then secondly, because it's hardware, there's a hard cost to it. And if it's most cases, you don't want to be losing money as you scale your business. And I remember one of the companies we invested in where the company sounded great, the thesis was amazing, and then we actually looked at the financial model and realized the unit economics was, if the company was growing, they would be losing more money. And so actually that went, oh, okay, maybe we shouldn't go. Next steps from there.
Founders know if they're actually ready to raise, and if they're not, what's some practical advice that you have for what they can do to make themselves more investable?
Sure. I mean, I think it's hard to know without knowing the specifics of a particular company. But again, to Rachel's point from earlier, one of the things that we often do when founders send in their deck, and it's not one for us at this point in time, is give them some feedback around what we'd need to see in order for that company to be investable for us. And oftentimes that's the way that relationship does start, and then you might find that you invest down the track.
I would also just say that there are many times where a founder isn't quite ready. Maybe they're still trying to figure out the problem, and there's some customer research that needs to happen. And in Victoria, where we are, we have amazing sets of programs, from pre-accelerators to accelerators, that can really help founders go from, I understand this problem and I'm not quite sure how to turn that into a business. And so there are tons of accelerators that LaunchVic have sponsored, and now they have even gotten into the pre-accelerator space. So there's really an entry point for everyone. And sometimes it's, online learning and self-guided. There's so much information available. The internet is full of content. And so great founders should be hungry and thirsty and should be self-servicing that content. have a good conversation with ChatGPT, but then meet as many people as you can and say, hey, how did you raise your first capital? What can I learn from that? Or what accelerator program did you do that was super helpful? Or who's the mentor that gave you the best piece of advice? Ask those questions and figure out how that you can unlock the incredible resources that we have.
I think one thing that founders probably don't realize is that most of the investors in Victoria have pretty good relationships with each other. We talk about wine, we talk about gin and tonics, we talk about a lot of different types of things.
Sometimes we even talk about the companies we haven't.
Sometimes, but hopefully not too often. But the very first thing that I would suspect that Justine would do if she gets a founder coming to her saying, hey, I'd like to talk to you about raising some capital, and that founder was in our portfolio, is you're probably going to pick up the phone and call us and say, hey, this founder's approached me. What do you think? Is this in line with what your expectations are, and so on and so forth. And those relationships, while we might have different firms that we all represent, those relationships need to be strong, because oftentimes, as Tim mentioned before, a few of us are leaning into the company to help do the heavy lifting to get it to the next stage. And so I think founders should be aware that those relationships are quite deep, and we work quite closely together.
Just to extend on that, I found it, I think it's very rare for a startup doing pre-Series A to have one investor come take a whole round, and which means that we have to collaborate. And that's why I think having that conversation openness is important. But hopefully we do get to a size where we can start being really competitive with each other, and we can start taking whole rounds out.
We were just reflecting, we've known each other for 10, 15 years at this point. Rohan, same. Justine, we were just at dinner together not too long ago. And so we bump into each other. And when we bump into each other, we don't just talk about wine and gin and tonic. We talk about companies we've seen. We talk about deals that are interesting. Do you want to co-invest? To the point earlier, many of us are co-investors by design. And so we do work very collaboratively. And the people we reach out to are often the people who we bump into at the cafe or bump into at an event or a pitch contest. And so we have a really tight-knit community here.
What I really appreciate about this investor community is a real frank conversation around why there's no's. I mean, we all don't have to agree on why a company is investable, but what we can share quite comfortably is this is our hesitations, these are the challenges that we see, and we don't necessarily need to agree that that is the deal breaker to a deal, but it allows us to really challenge each other, and I think there's a healthiness to that. I always look at every year the gala that LaunchVic holds, then it is a real community. It is a big room, and I would really challenge to say that can a room like that be brought together annually across the nation? For us, we really acknowledge that our fuel is not necessarily the capital we manage, but the founders we get to work with. And being an early stage investor, we need more early stage companies coming our way. Otherwise, we have nothing to invest in. And particularly looking at time and momentum and horizon. And so a ecosystem that really acknowledges that you need to fill the top of the funnel and keep filling the top of the funnel, as much as supporting those at the growth stage and really building better management and better teams and better founders and better scale-ups, almost a high chance of scale-ups succeeding. Having a real robust funnel and having a long-term commitment that it keeps growing is what draws us to an environment like this, where we know that we're not going to come in, do our due diligence on the ecosystem, and then we run dry on deal flow. Having a continuous funnel of new emerging startups that get us out of bed, that makes us smile, that makes us feel young, saying that we're given the same advice 10 times over, is really what keeps us really vibrant. And I think that's the nature of startups, is that innovative flair, and to just keep that spark going is really important.
And speaking of vibrant, we're of course here at Sanders Place in Melbourne, and it's a great co-working and event space with a high focus on impact startups. So it's testament to the number of places and spaces that people can find in Melbourne to connect and build from here.
Well, even just coming in to meet up with you guys, I ran into two people I knew downstairs, had a good chat, another co-investor, another founder. So this is the kind of density that we see everywhere. We're here in Cremorne, which is kind of the epicenter of the startup world, but wherever you are in Melbourne, you're going to bump into someone you know, and that's where connections and magic happens.